First couple indicators we're looking at here are the stochastics and the demarker indicator. We applied them with the default parameters. I didn't want to alter the parameters to try and best fit the indicator to the data and doctor the result. This is just to introduce rigidity to the rules, and increasing that rigidity would only mean that they're more likely to break down the track. So we're just looking for the basic rules to guide our trading, and rules that can be used over, many ranges. Now the trades we'd put on to after the range was established, so the arrows here are indicating the different trades that were put on. The stochastics, which is this bottom oscillator down the bottom here, we were putting on long trades when the percent quick line, the percent K crosses percent D down here in this oversold zone. I wasn't interested in crossings up here where it's overbought. It would make no sense. So we went long at this area, squaring the trade when the pink quick line crossed the green line. We would square the trade. We would look to go short at the contra side up here when this percent K went through the percent D. So looking at the actual some crossings outside, one more thing I needed to point out is that crossings outside of these zones we wouldn't go long or short on. So we'd only, if that occurred, we'd only square up a previous long or a previous short. So we're only interested in initiating trades in these zones here, here, here. So we can see the indicator made around 300 pips during this 2-month trading period. It's a great period in March and April in the Kiwi. The maximum negative trade, so our worst trade was around 66 pips and the best trade around 89 pips. Out of 11 trades open, only 4 were losers. So we can see that the stochastics actually worked pretty well. Just have a look at the arrows here. You can see the long arrows denoting the long trades and the short trades. The short ones are squaring trades. It's the same for the demarker, the yellow arrows here, the same thing. The rules for the demarker were that it would go long when it came out of the oversold zone, squaring it as it went up into the overbought and come back out. If it subsequently dipped back into this oversold zone after going long, we'd cut the trade. And the contra on the top side, if it went back up into this overbought zone, we'd got it wrong. The momentum had turned, so we'd stop out of that position. We can see, unfortunately, the demarker was a pretty poor performer, really. In fact, excluding this final trade here, we can see, it didn't square up till well after the support line here had broken. That excluding that trade, we only made 68 pips. Including it, we made 330. The worst trade being a 90 pip loss. With its final trade, our best trade was 262, but only 78 actually in the range, so it wasn't a particularly great performer. The indicator held that last trade open a lot longer than the stochastics, and that's due to its lower sensitivity to the small retracements. So you can see a small retracement here. We got a crossing here on where percent K cross percent D, so that meant the stochastics trade was squared up from short, whereas the demarker didn't call for a covering position until quite a bit later. So we can see this lower sensitivity that the demarker has to against the stochastics. If you look at the orange initiation trades of the stochastics, they're always before, or pretty much typically always before these yellow arrows of the demarker. So it was a less sensitive indicator and much better trading during the range. So we'll now move on to the RSI. We're going to look at firstly at the hourly RSI. Again, we're looking at the signals after we've seen the support and resistance. Arguably, we could have put on a trade, and I'm calling that the first trade here simply because it had come off this resistance. We saw divergence here at 0.1, and now as is often the case with the RSI, it was probably divergence trades that really were the best. One here at 1, 2, 3, and to a lesser extent 3 here, and 4. Now, for divergence, as we know, you get a new high set in the currency and a lower high in the indicator, or a lower low in the currency and higher highs in the indicator. So it was the divergence trades that performed pretty well. So let's just look at a few here at point 3. We failed around 25 to 30 pips from that resistance at 82.90, so we needed a reasonably wide stop, but a good move back down. Point 4 here, we broke old resistance around 82.90. Trade was presented here as a second run to 83.14, which saw a much lower reading than in the RSI. Although not strictly a classic divergence, it's definitely very similar. The opaque arrows around here and here were also divergence trades out of overbought RSI levels, although the traders couldn't rely on the nearby resistance level for stop loss prediction. So as you can see, it's quite a wee way away from that resistance level at 82.90, so it was very hard to get on the back of those divergences. Unfortunately, the RSI really couldn't be relied upon to square entry trades. For example, here at point 3, we see the divergence, 145 pips sell-off down to around 81.20 here, but the RSI never reached this oversold level, so it didn't give us a squaring signal. The movements from the overbought and oversold levels were often well before the actual swing high and low was reached, making it often unreliable to use the trade signals from these rules alone. And you remember with classic trading off the RSI, you would look to sell as it went out of the oversold level, stopping if it went back through, and buy as it moves out of this oversold level here. And we can see this problem here whereby at point 5, you just find there we go around point 5 here, the RSI left the overbought zone here, only to revisit it shortly after, and it left us with a 15 pip loss. And at point 6, which is down here, we require the ability to withstand 46 pip move after it's left this overbought zone. So it's a pretty painful sort of a stop loss that we need if we're trading just off the back of these zones. At point 7, it would have been pretty effective trades using the zones as indicators, although again reinforcing the point that the traders need to use another method or indicator to time the squaring entry, because we don't get back down into this oversold level, so we need to use some other methodology to square the trade up. The last point I want to make on this slide here is here at the far right, where we see the currency weakening. It's breaking its range here at the beginning of May. We get subtle clues from the RSI where it can't move back over the 50 neutral level during this whole period, and that's the largest period of time in that 2 months that it wasn't able to get above this neutral zone. So that gave us a clue as to the potential way that the move was breaking. And of course, when it broke the support, we then had complete evidence.